CNBC TV 18, celebrating 15 years of leadership.
Our top story tonight, hope is in the air for SpiceJet. The cash-strapped airline is all set to submit a revival plan to market regulator SEBI, likely to seek a one-time exemption from an open offer as the new investor stake could exceed 25% after fresh fund infusion.
Wholesale prices remain on a tight leash. December WPI index shows marginal acceleration of 0.1% despite an unfavorable base. Finance Ministry sources tell CNBC TV 18 they see no reason why RBI cannot cut rates before the policy meet on February 3rd.
The World Bank slashes global growth forecast, sending equities and commodities into a tailspin. Copper hit its lowest level in almost 6 years. Crude oil prices continue to tumble. Deep cuts across Wall Street and European markets.
Oil companies continue to make hay of falling crude prices. Profits on petrol stand at over 6 rupees and diesel at over 5 rupees a litre. Sharp cut in fuel prices likely tomorrow.
The slugfest between the bulls and the bears continues. Major indices clocking marginal losses as volatility continues to haunt the Lal Street.
Stable policy, favourable tax laws and easier access to capital. India's tech honchos give their wish list to Finance Minister ahead of the budget. E-commerce CEOs attend pre-budget meetings for the first time, ask the centre to iron out tax issues.
Power and Oil Ministries propose major changes to UPA's gas pooling plan, asked the Cabinet to restrict the proposal for just 2 years instead of the earlier plan of 5 years. Also want to cut down the number of stranded power projects that can avail of the benefits.
Vidicon does foreign majors as it hopes to sell its telecom business before the upcoming spectrum auctions. Claims to have approached AT&T and Telenor for a potential deal. That's an exclusive.
There is a relatively larger or a greater than 50% probability that the rate cut is done in February rather than the governor waiting till March.
We would obviously like to hear RBI policy guidance, as well as we would like to see how the budget is going to shape up. Assuming that there are no nasty surprises in the budget, I would say beyond April also there will be scope for further cuts.
We also have a view that the February policy could see a rate cut.
They will not take any action before the budget, but budget will define the future trajectory of government finances as well as what is laid out for macroeconomic stability.
Well, inflation is easing and the pressure on Raghuram Rajan is mounting. The Finance Ministry has fueled hopes of a rate cut ahead of the February policy, but will the governor play ball? Good evening. Thanks very much for joining us on India Business Hour. Nantara, North Block raising the pitch for a rate cut yet again.
That's right, Shri. In fact, my sources in the ministry saying, and I quote them verbatim, they see no reason why rates should not be eased before the February policy. So like you said, all eyes on Governor Rajan.
But all the rate cut noise is doing nothing for our equity markets as the tug-of-war between the bulls and the bears continues. So let's kick things off with the day's trading action. A decent opening, then a sharp fall followed by a late recovery. It looks like volatility is here to stay. At the Lal Street saw some wild swings once again. The Sensex down about 80 points by the end of trade. Look at that graph on your screens. It tells you how choppy it was, struggling to regain the 27,500 mark. Ditto for the Nifty as it continues to drift away from the 8,300 level. The mid-caps also coming under some pressure, and that index lost nearly 30% today. Nantara, we're seeing a global commodity and equity market collapse today.
That's right. In fact, the Lal Street should be happy we didn't see that kind of a collapse. And here's the reason why global equities are under pressure. In a report released overnight, the World Bank has trimmed its global growth forecast for 2015 and 2016. It now pegs the global economy to grow at 3% this year, 3.3% in 2016. And that's below the previous June forecast of 3.4 and 3.5% respectively. World Bank's chief economist Kaushik Basu said India's economic growth should finally catch up to China's next year. And in 2017, 2017 at a pace of about 7%. And Shireen, the World Bank being quite clear, the world should not rely just on the US to recover.
Well, absolutely, and there is trouble in countries like Brazil and of course Russia on account of what we're seeing happen in the oil markets. Now, unease over the global economy has engulfed commodities and continues to dent equity markets as well. Copper futures diving over 6% as a major support level has cracked and triggered a host of stop-loss sales. The metal is often considered a barometer of industrial demand, so the slump lends extra gravitas to the World Bank report. Gold has recouped some of its losses as it nears the $1240 mark, and there is no respite for crude either. Brent is just above $46 a barrel, while NYMEX is at $45. Technical analysts that we've been speaking to seem to suggest that 42 could be the next support level as far as crude is concerned. But then, Tara, despite the good news that's coming in from the European markets and the ECB, the equity market's not reacting.
Not at all, and this was the good piece of news that came in for the European markets. The Advocate General of the European Court of Justice has given an interim ruling that favours the European Central Bank's outright monetary transactions. He said the bond buying program was compatible with EU treaties if certain conditions are met. The ruling is a major boost for the ECB's similar plans to purchase sovereign bonds as part of a quantitative easing program. So in a nutshell, Mario Draghi getting a go-ahead to try and unleash a massive stimulus program. But like Shireen was pointing out, that ruling has given little respite to European markets. They are continuing to trade in the red. In fact, if you look at the frontline indices, we're seeing deep cuts over there. The FTSE, for example, is down 135 points. The German DAX also on its part down by almost 0.7%. The French CAC down by nearly 0.9%. Across the Atlantic, shares on Wall Street also declined. The Dow Jones marking triple-digit losses. It's down almost 200 points, 180 points at the moment. The S&P 500 down 0.8%, and the Nasdaq meanwhile down almost 0.6%.
It doesn't bode well for our markets when we open for trade tomorrow. The overnight queues will not look good. But the big story this evening back home, it seems like SpiceJet's revival plan is finally taking some shape. The airline's top brass continues to meet with officials of the Aviation Ministry, and there was a meeting today as well. Sources say the SpiceJet management is likely to submit an investment plan before the market regulator SEBI, seeking its approval. CNBC TV 18 learns that SpiceJet will ask SEBI for a one-time exemption from an open offer, as the new investors holding in the company could exceed 25% after the fresh fund infusion. Sindhu joins us now with the latest developments. Sindhu, we've been seeing negotiations go on for the last couple of weeks now. What can we expect? And this business of SpiceJet approaching SEBI, seeking a one-time waiver from making an open offer because potentially the new investor will have more than 25% because of the fresh fund infusion. What seems to be the game plan here?
Well, Shireen, one ministry official told us in the afternoon that they are likely to move SEBI today. That has clearly not happened. Another very senior official told us just a while back that they met everybody in the ministry, but a plan has still not been submitted. So I believe there might be some last-minute glitches, but the plan could be it could come out very soon. Like we said earlier, it is possible that the foreign investment in the new plan could be beyond 25%. This may trigger an open offer, and this may require SpiceJet to go to SEBI and ask them if they can be exempted one time from the open offer, because we learn the foreign investors are not keen on an open offer. But and we've already also said that it is possible that SpiceJet may get the total investment of $200 to $250 million that we've been speaking of in tranches. Our sources have indicated that it is possible that they will get the first tranche of $100 million, or which is about 600 crore, sometime this week. But all of this is in the realm of speculation because the company has not confirmed anything. Ministry officials say that a deal is in the works and it is likely to be announced soon. But like we've seen in the last several days, it comes to a certain point and then negotiations start again. So we'll have to just wait and see if tomorrow some kind of a finalization is achieved. But separately, like we said earlier, there's going to be possibly massive restructuring of the airline if and when the investment happens. It is possible that up to 2,000 or even more people may be reduced from the total workforce. It is also possible that new investors led by Ajay Singh will take a hard look at what kind of an LCC operation SpiceJet should run. Should it continue with a twin fleet operation? It has a Boeing fleet and a Q400 fleet. So all these things will have to be decided once the investment comes in.
Absolutely, and there is a big question question mark on when that investment is going to come in. Sindhu, appreciate you joining us. For more on this, we're joined by Kapil Kaul of the Centre for Asia Pacific Aviation. Kapil, appreciate you joining us. You know, we've been reporting now negotiations and conversations that have been on between Ajay Singh and the consortium that he's leading, the Aviation Ministry and, of course, the management at SpiceJet. But do you believe now that this business of seeking an exemption from a possible open offer could be a spanner in the works and could delay the possibility of stitching up this deal?
First of all, for me, I'm very interested to know that what is the role of the promoters. My understanding is that there are two critical aspects to this. Is that the promoter has to put in about 100 million or closer to 100 million. And then the investors come on board, and then the stage 2 happens. Second is that the promoter puts in about 100 million. Will he just give up the company that as it is planned, that the exit cost would be 700 million and the new investors take over? And the promoter's role to me is very critical. I don't know how he sees it at the present moment. I'd be surprised that if he puts in about 100 million as is being sought by the new promoters and then exits the company completely. Or he may have second thoughts that we're putting in about 100 million. I might run it myself and seek an investor. Or for that matter, I will be involved. I will dilute and then get new investors on board. So I am not very sure that there is clarity as to what the promoters should be. So
you're absolutely right, because there's been conflicting reports coming in on whether the promoters want to exit altogether or whether the promoters want to in fact stay on in some fashion.
You know, Shireen, the point is that the oil prices have fallen down significantly, and there are chances that it will fall further, and the oil prices might remain very soft for quite a lot, months, and then harden up post-October. It's very much possible that the promoters might be thinking that we've seen the worst. If we have to put in 100 million plus, do we need to exit completely, or let's run it ourselves and seek an investor on our own? Rather than surrendering the company for about $100 million. So I think the first starting point is this. Once that is very clear, whether he's putting the money himself or he is putting the money to stay or he's putting the money to exit. Second stage, I think everything is possible. That's a restructuring, even if they ask SEBI for a one-time exemption. Those things are second stage to me. I don't think there is clarity on the first stage as to what the promoters are going to do. For me, 100 million, whether he stays, or 100 million, whether he exits, that's fundamental to the next step happening.
Do you believe that we are likely to see this deal being stitched up, given the uncertainty around it, anytime soon, Kapil? Because as I pointed out, conversations between the three parties involved, including the Aviation Ministry, have been on since December.
Well, first of all, I must appreciate, Shireen, as I've been saying, that this is the first time I've seen a government after the first couple of bad decisions when this from booking and immediately cancel slots, which I felt is damaging. But they played a very positive role. They've just been there what a government should do. But I guess the government is also in a fix, in the sense that there's no clarity coming from the promoters. But my understanding is that it's not as easy as is being, coming out of the media reports that the deal is nothing. They will go to SEBI. I see that it might take a little while. And that will largely depend on what promoters want to do with the company. I want to reiterate that promoters' role, whether he exits or stays, is critical. And will he invest $100 million and exit friendly, or he decides to put in 100 million and either partly or completely, handles on its own. But I think there is more to SpiceJet than what is emerging at the present moment.
Well, it certainly does seem to suggest that there is much more to this story. But Kapil, appreciate you joining us here to take us through the pieces of information that we're gathering and trying to put together at this point in time. Of course, this is all source-based information that we're bringing to you. There has been no official comment from the company on the possibility of submitting a revival plan to SEBI. Nantara.
Shireen, now news from the macroeconomy. Inflation continues to decline and the pressure on the RBI governor only mounting. Wholesale price index for December showed a softer than estimated reading of 0.1%, and that's despite an unfavorable base. This as core inflation slipped to the lowest level in 60 months, indicative of the fact that the manufacturing sector is not picking up pace. The slight month-on-month uptick in wholesale inflation was largely driven by a rise in primary inflation.
And with inflation on the decline, North Block is hoping that a rate cut could be around the corner. And entire sources in the Finance Ministry, we believe, say that they see no reason why rates cannot be cut before the policy meeting, which is on the 3rd of February, as falling inflation has given elbow room to the Reserve Bank. North Block also believes that the time is right for interest rates to be cut. So, in this backdrop, what will the Reserve Bank do? Lata joins us now with more. Lata, inflation continues to slow down further. Is there now a cast iron case for a rate cut?
Well, I would agree with that. I mean, if you looked at the numbers, the wholesale price index as well as the consumer index falling, and wholesale price index actually has fallen now for the 5th month in a row, even month on month. I mean, year on year, of course, November was 0 and December, as we saw, was 0.3%. But consumer price index is the more important index which the Reserve Bank watches. Even over there, it's not just at 4.4 and at 5.2 in November and December. The number is also below the Reserve Bank's fan chart, which indicates its most probable trajectory of CPI. There, the most probable number was probably 5.5 for December, and what we actually got was 5.2. Similar for November, coming in below the Reserve Bank's trajectory. Chances are, therefore, that Jan, Feb, March also it will be below the Reserve Bank's trajectory and therefore below 6%. So that clearly indicates that there is a cast iron case. And there are, of course, other evidence as well. Global commodity prices absolutely crashing. Rural wages in India falling continuously, reaching a low of 3.8% in November. And I don't think industrial growth has any legs at all to pass on prices. So, yes, cast iron case.
It's an iron cast case. But, Lata, what are the chances that that rate cut could be this week rather than February 3rd?
Well, when the governor spoke on December 3rd, he gave 2 conditions for cutting rates. And clearly he admitted it could be outside the policy date as well. Now, one was, of course, inflation being below trajectory. The other one was fiscal consolidation. Now, there is a substantial segment in the market who believe that the governor will, considering that that is one of his conditions, want to look at the budget before he cuts rates. And therefore, they put March first week as the likely date. March is also out of turn because the credit policy is on Feb 3rd and then it is in April first week. So, an out of turn cut is being interpreted as March. But, you can make an equally good case that the governor himself admitting that in the previous policy that he is looking at the current fiscal consolidation and not next year's number. And this year it does look like the government is on track to get that 4.1%. So you can make an equal case that, inflation is below trajectory. So the out of turn policy should be Jan and not Feb. Now, actually, practically speaking, there is not much difference. A rate cut 17 days earlier than February 3rd is not going to give us a 10% GDP. So, I mean, you don't really have to squabble about it unless it's an ego battle. But there could be some harm if the rate cut came earlier because it will be read as extremely dovish. I mean, the data was so good, the governor couldn't even wait. He had to do it on Jan 16th rather than Feb 3rd. That will push the bond yields to perhaps 7.5, expecting that another cut is going to come in March, which may not be very good because we must remember that rupee depreciation is clearly related to rupee inflation. If you give the feeling that you are letting loose of your inflation battle, then if there is a global turmoil, the rupee becomes a little more fragile. So I would think, therefore, there is a mild danger in sounding ultra dovish. But, if there are political battles being fought, that's a different story.
Well, we'll see which way the story unfolds. Before the 3rd of Feb or post the 3rd of Feb or on the 3rd of Feb, those are the questions that only the governor can answer. Now, the government is all set to add more companies to the disinvestment list as it scrambles to mop up revenue. Sources say IOC, NMDC, NALCO, BHEL could be the candidates for stake sale in this fiscal. Remember, we've been reporting this for over a month now that the government is looking to widen the disinvestment basket and not rely on just 1 or 2 big sell-offs like ONGC and Coal India. So these could be disinvestment candidates for this fiscal. Nedar.
That's the widening of the net as far as divestment goes. But software industry body NASSCOM is going all out to ensure Indian IT players stay in India. For this, it has asked the government for favourable tax laws and easy access to capital. CNBC TV 18 gets you a glimpse into the IT and e-commerce sector's budget wish list, which has been presented to the government today.
Vishal Sikka of Infosys, Vineet Nair of Tech Mahindra, Suresh Senapati of Wipro, Snapdeal's Kunal Behel and Flipkart's Sachin Bansal. These are just a few of the captains of Indian IT and e-commerce who made a visit to North Block to appraise the government of what their sector needs in Budget 2015 to help India kickstart growth. This year's wish list has the usual suspects, from favourable tax laws to easier access to capital to a stable policy regime. And the hope now is that after 3 years of being ignored, Indian IT and e-commerce will get a higher billing in Finance Minister Arun Jaitley's Budget 2015.
We have proposed our point of view. Obviously, there are some areas where, for example, double taxation exists in VAT and treating software products like physical goods and things like that. We are all collectively of the same view in the industry, but nevertheless, obviously, this is something that has to go through the legislative process.
In this particular sector, given that it deals with intangibles, it's possible even for a small company to locate anywhere in the world. So unless we benchmark ourselves and the regulatory and the taxation environment with what is prevalent in other countries, we will not be able to prevent such a movement.
The coverage was entirety, whether it was a taxation, capital market, direct taxes, indirect taxes, ease of doing business, digital India, skill India.
I think we shared some of the current inconsistencies potentially that we are facing on the taxation piece, and I think the government is very understanding of those.
We are also the recommendations that particularly I made were on data centers. India should get more data center investments, and that requires some tax benefits that should be passed on to that industry while it is in the very nascent stages.
It's a long list that includes a proposal by NASSCOM to bring the tax on digital transactions at par with the physical world to facilitate greater adoption and migration to technology-enabled platforms. But just how accommodating the finance minister will become clear only when he gets up to announce the budget in late February this year. A CNBC TV 18 report.
Well, it's good to see the likes of Snapdeal and Flipkart make representations to the finance minister ahead of the budget. On to a CNBC TV 18 exclusive. Gas pooling, the brainchild of the UPA government, has been finalized into a cabinet note by both the power minister as well as the oil minister. Now, sources say the cabinet note, which was the earlier proposal, has been reworked quite a bit. Gas pooling will now be only for stranded gas power plants with a capacity of 16,107 megawatts and not the 24,149 megawatts envisaged earlier. What's more, the proposal is for 2 years and not for 5 years. Also, there may be 2 gas pool operators. So besides GAIL, the NDA government is in favour of Gujarat-based GSPC also being an operator. And in more bad news for GAIL, the 2 ministers have mooted steeper cuts for its tariffs to make the gas pooling concept a viable option. The new proposal is to cut GAIL's marketing margins by 75% and pipeline tariff by 50%. And in negative news for Petronet LNG, its regasification charges may be slashed by 50% again to help reduce the price of pooled gas. Those stocks down by about 2% or so. But Nantara, good news likely for you and me.
That's right, Shireen. We understand from our sources that oil marketing companies' over-recovery on diesel since the 1st of January stands at 5 to 5.5 rupees a litre, and on petrol at around 6.5 rupees a litre. Now, that also includes the amount of over-recovery or profit that the companies had refrained from passing on to consumers last time round. We're talking about December the 16th. Sources say that at the upcoming price review scheduled for tomorrow, we may just see these benefits being passed on to consumers. Sources indicating perhaps we're going to see diesel and petrol prices being cut by almost 3 rupees a litre. And if the top leadership of the government insists and asks the oil marketing companies, it could be bigger. Let's not forget the Delhi elections around the corner.
All right, so what are you betting on, Nenta? 3 rupees, 5.5, 6?
Not 6. I find that really difficult to believe. That might be closer to 7th of February when Delhi elections are around the corner, when people will remember that when they perhaps go to the booths. But with this government, you never know.
All right, but we'll take what we get. And as we celebrate 15 years of leadership, we introduce a special initiative, the Indian Business Icons 2015. The endeavor is to form a distinct league of the most powerful business leaders the people of the country think have had a monumental impact on the economy. So you can now get voting. Voting is open, and of course you can tweet, Facebook, or give us a missed call. We've got 30 shortlisted icons, and here's a look at one of them.
CNBC TV 18's Indian Business Icons. Leaders, trailblazers, radicals.
He's the head of a $40 billion conglomerate, one with an indelible footprint in 36 countries across 6 continents. So it's no surprise that Kumar Mangalam Birla's name is today synonymous with the spirit of enterprise and success. Birla, who took over the reins of the Aditya Birla Group at the age of 28, has been the driving force behind building what is easily India's biggest multinational company. His global vision, sheer determination, foresight and sharp business acumen have helped him prove his detractors wrong over the years and successfully silent critics who doubted his ability to lead the group after the untimely demise of his father in 1995. Over the last 17 years, Kumar Mangalam Birla has not only taken the Aditya Birla Group onto an altogether higher growth trajectory, he has also built a meritocracy that boasts over 120,000 employees belonging to 42 nationalities. These years have also seen Birla spearheading a global acquisition spree, including flagship company Hindalco's $6 billion acquisition of Atlanta-based Novelis, which made Hindalco the world's largest aluminum rolling company and one of the biggest producers of primary aluminum in Asia. Himself the recipient of numerous awards and accolades, Kumar Mangalam Birla has worked tirelessly to enhance stakeholder value many times over. And for this, we believe he is clearly one of India's biggest business icons.
CNBC TV 18, celebrating 15 years of leadership.